Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. I am Kishore Muktinutalapati, equity strategist for ADCB. On the show going forward, with an objective to empower you with investment insights, my colleagues and I will be discussing various perspectives shaping the global investment landscape. Let's get started with this week's content. End of quarter always provides a good opportunity to take stock of the situation in financial markets. In that context, the third quarter ending 30th September has been quite mixed, to say the least. Spread of the COVID-19 Delta variant dominated the discussions, but had fairly muted direct impact on financial markets. During Q3, economic activity eased from the peak growth rates of Q2. Purchasing Managers Indices, or PMIs, widely considered as real-time indicators of economic momentum, have rolled over across the globe. Data disappointments continued. The Citi Global Economic Surprise Index, that measures the extent to which the reported data is above or below expectations, fell from a positive 90 level to a negative 24 level in just the past 3 months. These disappointments came from across the world, but the news flow out of China dominated. In China, concerns of hard landing of the economy increased as the regulatory crackdown intensified against the backdrop of a weak credit impulse and supply-side bottlenecks. Also, zero-tolerance policy of China towards the COVID-19 outbreaks was not particularly helpful either. On the inflation side, data pointed to a hotter economy. In the US, core PCE continued to trend higher, although some transitory price pressures eased. Inflation in the Eurozone and the UK continued to surprise on the upside and remained in an upward trajectory. Also worth noting that inflation forecasts have been revised up in recent months not only by the Wall Street economists but also by organizations like the Organization for Economic Cooperation and Development, that is OECD, and the US Federal Open Market Committee, FOMC. During Q3, central banks have turned a bit more hawkish. On the one hand, central banks including the US Federal Reserve, the European Central Bank, the Bank of England, all discussed their plans to taper asset purchases. On the other hand, some central banks in emerging markets like Brazil and Russia have increased their policy rates to counter inflation. Turning to developments on the political side, the US Congress continued to debate on raising the debt limit and funding Biden administration's spending plans. In Germany, results of the federal elections pointed to a range of coalition possibilities, and talks between parties to form a government there could take longer. In Japan, the Liberal Democratic Party elected Mr. Fumio Kishida as their next leader. Mr. Kishida will now be leading the LDP in Japan's general elections in November this year. Now, focusing on the financial market performances during Q3, equity markets rose during July and August but fell during the seasonally weak month of September to end the quarter with marginal loss. Worth noting that September followed 7 consecutive months of gains in equity markets. MSCI All Country World Index is now up 11% so far this year. In the fixed income space, both sovereign and corporate bond segments lost value during Q3. Especially during September, various bond segments registered losses as yields pushed higher. Remember, yields and price are inversely correlated, and higher yields mean lower prices. Commodity prices rose during Q3 and were led by strong gains in energy commodities like oil and natural gas. Prices of agricultural commodities and precious metals lost some value during Q3. Industrial metal prices fell during September on concerns relating to a hard landing of the Chinese economy. Turning to currencies, the broader USD gained during the third quarter. While the pound sterling and the euro lost circa 2% each against the greenback, the Japanese yen has been rather flat. Emerging market FX lost circa 1% against the US dollar during Q3. Real estate investment trusts, or REITs, came under significant pressure in September, creating a drag on overall Q3 performance for that segment. Now, looking ahead as the economy and the cycle matures and moves from an early cycle environment to a mid-cycle environment, macro uncertainties tend to rise. Such periods are almost always associated with volatility in financial markets. However, as the cycle matures into a new normal, uncertainties should start to fade and provide a reasonably clear path for financial markets. Also, most financial market assets, especially risk assets, have performed very strongly over the past 18 months as the early cycle environment supported. But as we stare at the mid-cycle, it might be reasonable to expect the returns over the next 18 months to be markedly lower. Well, it doesn't mean negative returns, but lower positive returns. Taking all these dynamics together, we think investors are better served by staying invested in a well-diversified portfolio of assets over the next 12 to 16 months. Thank you for listening. In case you would like to get more information on what was discussed in this podcast and what all this means to your investments, please reach out to your contact at ADCB. Also, subscribe to this podcast on the ADCB YouTube channel or wherever you listen. Thank you once again, and this is Kishore Muktinutalapati signing off.